Hello and welcome to Story 4 of the 7 Claim Stories series. My name is Vicky Churcher, I'm the Executive Director here at the IPTF, and I'm delighted to be joined today by Tom Salmon, Senior Claims Assessor at Pacific Life Re. Hi Tom.
Hello, thanks for having me.
You're very welcome, lovely to see you. So Tom, our subject today and story 4 is income protection explained, how to get it right. So if I could just start by asking you, why is income protection often misunderstood at claim stage?
Unfortunately, it's very common to see confusion at a claims assessment stage, and that obviously adds to a claimant's worries at a time where they should really be concentrating on treatment and recovery. So, sort of to alleviate questions and concerns at claim stage, it's my opinion that a full education of how the policy works should be provided at that point of sale and the years beyond that as well. Ultimately, we want to get to a situation where there is absolutely no surprises come claim stage. If people know how the policy works and what the claims process looks like, then we should really see a reduction in that claimant frustration at claim stage and also a reduction in complaints as well. So a common misconception at claim stage is that a claimant will assume that the policy will replace their full salary. But that's really never going to be the case. Most policies cover probably around 60 to 65% of an income, and that's very much deliberate. You know, that's to keep costs manageable, but also to have that sort of financial incentive for somebody to return to work when they're able to do so. And that misunderstanding really does come down to a lack of clear explanation and education at the point of policy sale. But again, I'll stress that it's not just at policy sale. It's the responsibility of, everyone, insurers, IFAs, and also the policyholders themselves to actually understand how that policy works and what it's going to do when it's needed, basically.
Thanks, Tom. That's interesting. You talk about surprises, and we know that some people don't always receive the full sum assured when they make a claim. Why is that?
Yeah, I mean, that really is very much one of the biggest I didn't know that moments when it comes to claim stage. So an example of this, say somebody discloses an income of £50,000 at policy sale and they want to protect a proportion of that. Your sum assured's probably going to be in the region of about £32,500, and that's that 65% limitation of benefit that we're talking about. So even if your policy does have £32,500 a year of a sum assured, that doesn't automatically mean you're going to receive that amount. Your benefit that you're going to receive at claim stage is very much based on your income in the 12 months prior to your absence from work. And then it's limited to that percentage that we've been talking about, that 65%. But then on top of that, we need to take into account any other income, like sick pay, for example, and any other income from the company that you might have as well. So it's not necessarily a bad policy if you don't receive that full sum assured. It's really about understanding what that policy is going to do and how that benefit's going to be calculated. And again, it comes down to explaining that at policy sale and beyond. Ideally, we'd be seeing IFAs providing that information to people, to policyholders when the policy's taken out. But again, I come back to it's down to all parties to maintain that education throughout the policy life.
Okay. Thank you. And just recently, in the profile of an income protection report that we launched in association with Iris, it was very clear that a big chunk of the underserved market is the self-employed, and I think the government have also identified this. Is income protection more complicated for self-employed? Is that why there's a gap?
Yeah, on the financial side, it very much can be. I think if we look at employed people initially, quite frankly, you would have likely consistent salaries, and then employer's sick pay. We talk about those deductions. That employer's sick pay is pretty much a set amount, so it makes that process a lot more straightforward for the employed people. We're just looking at pay slips, P60s. You would like to think it's generally a lot easier to calculate the PDI and continuing income and things like that. PDI, I mean pre-disability income. But for self-employed people or directors, things like fluctuating income, business turnover, I mean, that can lead to overestimations. Um, I mean, something we see quite frequently, unfortunately, which is key, is that you really should be basing your income for self-employed people on your net profit of your company, essentially, not the turnover. So if you're reporting a turnover of £100,000 for your company, but the net profit of that company is £40,000, for example, obviously minus the expenses and everything, then really you should be basing your sum assured and the level of cover against that £40,000. Otherwise, if you disclose your turnover amount of £100,000 as your income, you're essentially going to be paying a lot of premiums for that cover. But ultimately, you're not going to get that level of cover. You're going to get a benefit calculation against the net profit of £40,000, leaving a sum assured of about £26,000. So there's a big shortfall there. You're paying a lot of premiums against a policy where you're not actually going to be able to claim that full amount of benefit. And ultimately, when that happens, it can lead to complaints at claim stage. Sorry.
Yeah, that's an interesting example, really good example, actually, I think, because
We see that a lot, unfortunately. And again, it's down to everyone to understand how that policy should be sold and how the benefits should be calculated.
so just to reiterate and underline that one, it should be on the profits, not the turnover.
That's right, exactly that. So that your profits are going to be your turnover minus all your expenses.
Lovely. Thank you. That's really useful, Tom. So we know that, in today's world, particularly post-COVID, there's more self-employed people in the workforce. I think it represents a figure I saw recently. It represented something like 14% of the workforce. Not just for self-employed, but generally with lots of changes going on one way and another. Do you think that today's income protection policies are suitable for today's customers?
Yeah, I mean, absolutely. If it is well explained, I'm probably getting a bit boring now, but it really does come down to education for people. Sort of modern IP policies are very much more accessible than they used to be. They're more flexible and can be tailored for different benefits, different budgets. I mean, we see a lot of limited payment periods or lower cover levels, lower sum assured. So it's no longer about just sort of protecting your mortgage anymore. It's about protecting paying your bills and your way of life, and obviously staying financially stable throughout illness or injury. So with the right advice and clear communication, with regular reviews, today's IP is very much a core part of having a smart protection plan.
So 3 key takeaways from me from what you've just said is education. Make sure advisors understand what is and isn't covered and the policies themselves.
Yeah.
Ensuring that customers understand, so making sure the advice is right at the beginning. And then thirdly, when it comes to claim, I guess get some help from the advisor themselves so that they can manage expectations and help see the claim through. Would you agree?
Yeah, I definitely agree with that. I mean, the advisors helping at claim stages is obviously very helpful, but obviously it's up to claims teams as well to make the assessment process as smooth as possible. And I've obviously worked in the direct office for much of my career, and we really do strive to make the process a lot easier for people. We're trying to do away with sort of physical claim forms and things like that, and writing down what actually needs to be provided in terms of the finances. Having those telephone calls with people to clearly explain what is needed and to provide that guidance. I think a lot of work's been done by all parties to ensure that happens.
In our first 7 claim story 1, guiding a client through a storm, we discussed how advisors can help their clients when it comes to claims. And one of the points Susanna Ritter made when we interviewed her was that not all claimants are email savvy. They don't know how to do a PDF. English may not be their first language. So Phil Deacon at that time has just explained that advisors can really help with that part of it. So that's important, but it is equally as important that the reinsurers and insurers who make the claims and the claims assessors help the process as much as possible and understand the customer's needs, particularly in today's world.
Yeah, definitely. I think for the insurers as well. I mean, we talk about the policyholders and claimants. I can assure you that insurers themselves want to make the process as smooth as possible. You know, we don't want to have to keep coming back and bugging people when they should be, you know, concentrating on recovery and treatment and things like that. So we do a lot of work on trying to get that information at the first point of call. But obviously, we know it's not as easy as that. We see tax returns, we see P60s, we see this information all the time. If I wasn't in the industry and I wasn't sort of self-employed, I can guarantee I wouldn't know a lot about the finances. So it really is about making it as smooth and easy as possible, and to use the IFAs and the agents to help with that is a very positive thing, definitely.
Well, thank you, Tom. That's been really interesting. And I think that's the whole point of this story is to help advisors to make it easier so that when it really matters and their clients need to make a claim, the claim is as expected. So thank you very much for joining us, Tom. Much appreciated, and I'll see you soon.
Thank you. Cheers.